Hi everyone. The new month and quarter began with mixed sentiment in stock markets. The NonFarm Payrolls reports were published last week confused investors. The result was obscure, so it's hard for speculators to assess the labor market conditions. However, they are positive about a 25 basis point rate hike in July. Roughly 95% of traders have already factored in such a scenario. They are not sure about a rate increase in September, given weak jobs data. Traders are trying to understand whether stocks are now in a short-term correction phase or it is a trend reversal. The new week will be rather challenging as the earnings season is around the corner. Apart from that, the US will unveil inflation figures. Several Fed policymakers will make speeches. If you want to learn more details, watch our video till the end. Let's start. On July 14th, the second quarter earnings season starts. JP Morgan, Citigroup and Wells Fargo will reveal their profit results. A week later, Tesla, Netflix, IBM, Bank of America and Goldman Sachs will do likewise. However, things will get really tense in the last week of July as tech giants will publish their quarterly results. Microsoft, Amazon and Alphabet will release their reports on July 25th. At the start of August, Apple will unveil its profit results. This season might be the toughest over the last 3 months due to worsening macroeconomic conditions. According to FactSet, the S&P is likely to see a year-over-year decline in earnings of 6.5% for the first quarter compared to last year's same quarter. In the first quarter of this year, the indicator fell by 2%. If the forecast comes true, it will mark the largest earnings fall since 2020 and the third straight quarter of a decline in earnings. Profit growth is projected only in 7 of the 11 sectors, with the strongest gains in the consumer discretionary and communication services sectors. A drop is expected in 4 sectors, including the oil and gas, the basic materials and the healthcare sectors. Revenues are expected to decrease by 0.4% in annual terms. Only 7 sectors are likely to post gains, while 4 others are expected to fall, especially the oil and gas sectors as well as the basic materials sector. Investors are also closely monitoring the profit forecasts of companies for the second half of the year, given the unstable macroeconomic outlook and increasing fears of a possible recession. Last week, the Dow Jones incurred significant losses, showing the worst performance among all 3 benchmark indices. Last Friday, it tumbled by 1.07%, the biggest intraday drop since May. The main reason for such a sharp decline was negative dynamics in the oil and gas, consumer and utility sectors. The downbeat labor market data also undermined growth. The figures turned out to be so mixed that it is quite difficult for investors to predict trends. The macro stats released on Thursday also surprised traders and renewed hopes for further monetary tightening by the Fed. According to ADP, private sector jobs surged by 497,000 in June versus the forecast reading of 160,000. A month earlier, 26,000 jobs were added. Hawkish expectations are bearish for stocks. ADP figures forced some analysts to increase the NFP consensus. However, NFP data also puzzled speculators. The economy added 209,000 new jobs in June, which was significantly lower than anticipated. At the same time, the May figure was revised downwards to 306,000. The unemployment rate fell to 3.6%. The average hourly wage increased by 0.4%. This indicator fueled hopes for new rate hikes. Some U.S. think tanks believe that the Fed will raise rates 2 more times and that will be the end. Chicago Fed President Austin Goolsbee is confident inflation can be tamed without a recession. Investors are now cautious ahead of the upcoming inflation data. Last Friday, market sentiment improved amid a weaker than expected NFP report. Perhaps traders decided that they were overly excited on Thursday. Nevertheless, investors are still optimistic, using any opportunity for making a profit. As for inflation, the consumer price index and the core inflation index are likely to drop at a slower pace. This is why the Fed will hardly start discussing monetary policy easing. The annual CPI is expected to be between 3.6% and 3.8%, down from 4% in May. The CPI peaked at 9.1% last summer. It has been gradually decreasing since then, although it is still well above the Fed target. Meanwhile, the core CPI is forecast to be 5.2% compared to 5.3% in May. This indicator is a crucial gauge for the Fed, as it allows policymakers to more accurately assess the inflation dynamic. Inflation is slowing but not fast enough to end monetary tightening. Despite the steady decline, inflation is still above the 2% target. If the inflation figures turned out to be unexpectedly high and the annual rate reaches or exceeds 4%, this will put additional pressure on the Fed in terms of combating inflation. Last Thursday, the S&P logged the worst intraday performance since May. Nevertheless, the weekly losses of the S&P were not so deep. It dropped by 0.9%. Its further trajectory will depend on the earnings season. The S&P may still test the resistance level of 4,535. Even if it touches this level, it will hardly grow higher. Hence, a downward correction or consolidation is possible. If it keeps rising, it could hit the resistance level of 4,593 and 4,637, a high of March 2022. The support level is seen at 4,422. The pivot level is now seen at 4,380. A close below this level may indicate that the stock market may be approaching a peak. However, only a decline below the low of 4,328 will indicate the formation of a peak in the short term. As for the long-term prospects, analysts are betting on the continuation of the rally. Bank of America predicts that the S&P index could reach 5,000 by next year, an increase of at least 13% from current levels. Analysts compare the current long-term bull market, which began in 2013, with the trends observed in the 1950s and 1980s. Bank of America noted that the 24% rally on the S&P from the October 2022 low relinks to the 2013 to present secular bull market with the 1950 to 1966 and 1980 to 2000 secular bull markets. If this trend continues, the S&P may exceed 6,000 by 2026. This forecast assumes a potential growth of 36% over the next 3 years. The rally may continue at least until 2028. Over the week, the NASDAQ lost 0.8%. This can be attributed to a correction. Its further movements will depend on fresh reports. Stocks look quite attractive now. After all, a historic moment is coming. The Fed is likely to wind down its tightening cycle, signaling a weakening of inflationary pressure. It boosts speculative trading. Among all indices, the NASDAQ notched the best performance. It has jumped by a record 31% this year amid the artificial intelligence boom and high demand for stocks, which have recently experienced a significant drop. Currently, the NASDAQ is showing signs of a temporary slowdown in growth. A correction after the current rally may lead to a decline to 13,500, although a deep pullback is possible. However, such a scenario requires more drivers. The Fed's hawkish stance will hardly cause a sell-off in stock markets. Reports about the contraction of the economy or weak earnings results could trigger such a steep decrease. If a fall is strong enough and the Fed sticks to aggressive tightening, the NASDAQ may take a nosedive to 12,500 and 12,200 in the long term. At the moment, there are no signs of a bearish reversal. That is all for now. Hit the subscribe button and stay up to date with the latest market developments. See you!